In this segment, we are going to cover why we adjust for capitalized interest. Capitalized interest comes into play when a company self-constructs rather than purchases an asset for its own use. For example, if a company builds a new office building for itself, a new plant, or builds a large piece of machinery, and uses debt to finance the construction of the project, the interest associated with that debt may be capitalized. And so while you may find capitalized interest being recorded by companies across a variety of sectors, it's predominantly found in industries which involve large-scale, self-constructed projects, such as in the oil and gas, utilities, railroads, and capital goods sectors. What is capitalized interest, and why do we adjust for it? Interest that is recorded as part of the cost of the self-constructed asset is called capitalized interest. Under US GAAP, and IFRS is very similar in this regard, assets which are purchased or self-constructed are stated at cost. However, unlike a purchased asset where the purchase price according to the contract is known, a self-constructed asset requires that certain costs be allocated. Accounting rules generally require that all costs necessary to get that asset ready for its intended use should be capitalized. In other words, costs such as materials used to build that asset are capitalized. Construction labor gets capitalized. General overhead may get capitalized. And if a company finances those costs or other aspects of the construction project with debt, then the interest cost gets capitalized as well. Capitalized interest then flows through the income statement as depreciation expense over the useful life of the asset. From an analytical perspective, since we prefer to focus on a company's total interest cost, we reverse the amount of interest capitalized and include the amount as interest expense. In the cash flow statement, we reclassify capitalized interest from an investing activity to an operating activity. This has the effect of reducing operating cash flows, funds from operations, and CapEx. Free cash flow remains unchanged. How do we adjust for capitalized interest? Our capitalized interest adjustment is relatively straightforward. Generally, we find the information we need in the plant, property, and equipment footnote. In this example, the 2010 capitalized interest amount was $532 million. On the next slide, we show you our reconciliation table, which provides transparency into the way reported numbers are adjusted. Here, you'll find a row for capitalized interest. The adjustment that we make to interest expense from the previous slide was $532 million. That gets added to interest expense. And you'll also note that that same amount gets deducted from cash flow from operations, funds from operations, and capital expenditures, as we mentioned previously. It is important to point out that in theory, plant, property, and equipment should be reduced for the portion of past interest capitalized. However, for practical purposes, we do not make that adjustment because it is not analytically meaningful given our focus on coverage and profitability measures. So in summary, why do we adjust for capitalized interest? Because certain interest costs, namely those on self-constructed assets, are capitalized rather than expensed. Capitalized interest comes through the income statement as depreciation rather than interest expense. Since we prefer to focus on a company's total interest cost, whether it's capitalized or expensed, we adjust capitalized interest and reclass it to interest expense, enabling better comparability of interest costs across the companies we rate.